Our first presentation deals with slumping sales at CPG companies by Dr. Kurt Jetta of the TABS Group. But first, some housekeeping items. All attendees are in listen-only mode. If you have questions, type them in the chat box in the lower left of your screen. We'll answer them along the way as time allows. Now, between each presentation, there will be a CPG and retail trivia quiz for valuable prizes, including the grand prize of a Kindle Fire HD. So stay tuned. Now, all sessions are being recorded. We'll send links to the presentation and recordings by the end of the week to everyone registered for the conference. So, our first presentation again deals with slumping sales at CPG companies. Why is that happening? Joining me now to answer that question is Dr. Kurt Jetta, CEO and founder of the TABS Group, a technology-enabled analytics firm serving the consumer products industry. So, without further ado, here is Dr. Kurt Jetta.
Thank you, John, and thanks everyone for attending, and particularly for the new folks that have not sat in on any of our prior webinars. This is a great forum to have these types of information sharing. You can efficiently just see some of the options out in the market, and hopefully you'll learn a few things on the way. So I'm going to talk about our research that we've done over the last year and a half on what is wrong with the CPG industry. I think there's a lot of misconceptions going around on what's causing it. You hear about cautious consumer and migration to online, etc. So we'll break this down into two areas, meaning the external factors, things that are somewhat out of our control, what's happening in the economy in general. And then industry factors. Now there's way too many issues to cover, obviously, in a 1-hour webcast, but there's going to be two that I'll focus on in particular: trade promotion and loyalty programs. And there's a reason why there's a double quote around the word loyalty that I'll get to later on in the presentation. At the end, I'll just have a call to action on things that we can do coming out of this presentation tomorrow to start generating sales and start to mitigate some of the sluggish trends that we've been seeing in our businesses as a whole. Just as a matter of information, I'm going to be referring to some prior webinars that we've done. So there will be times where I'll make a contention or not build out fully the proof of something that I'll be stating, for example, the efficacy of trade promotions or how it skews to heavy users. All this information is contained in one of these various webinars that you can find on our website under webinars.tabsgroup.com. And in fact, we have another one coming up on May 20th at 2 o'clock Eastern to talk about the 8th annual Vitamin and Sports Nutrition Study. We've been tracking it since 2008, and there's some interesting findings there that I think many of you would be have some value to sit in on. But we're here today to really talk about what's wrong with the CPG industry, and let's talk first about some of the macroeconomic factors. So there is no question that our categories, which are consumer packaged goods, are lagging the industry as a whole, meaning the overall economy, but it's not nearly to the extent that I think a lot of people think it is. So if we look, say, right here, what the growth rate was in consumption through 2012 all the way to 2014, yes, there is a little drop-off, but that's still some fairly healthy growth. If we look at food and beverage, which is the best proxy for our industry that the government tracks, it was at 4, so slightly below overall consumption. That gap increased quite a bit in the most recent 3 years. So all of a sudden we see a bigger share loss to our industry of total consumption. But certainly it's still not a sluggish by any means rate at 3.2. Now the 2.3 is. And then if we go to the track channels to see the IRI or Nielsen that they've published, we're only really seeing a 1.5 growth. And that's at historically low levels. versus what we've probably been used to. Our own research that we just did in consumables confirms those sluggish trends. So the top 15 consumables categories, overall we were seeing flat volume. And these are the ones that are highest volume, highest velocity, bellwether categories for the industry in general. And you can see how most of those categories are flat to declining, and they're really representative of some of the mega vendors in our industry: Coca-Cola, Unilever, Mondelez, Kraft, etc. The real interesting insight was the big drop reported by female millennials. 14 of the 15 categories had very sharp double-digit drops or close to double-digit drops. Only one was flat, and that was frozen pizza. And we always trying to do an extensive job of corroborating results that we're not expecting. So you see quite a bit of discussion on what can we do to appeal to millennials and targeting the millennial shoppers. I don't think there's a fundamental understanding that there's been a real sharp drop-off, particularly among women, in that target for our categories. And what's driving that? Well, there's a few demographic and macroeconomic factors. First of all, these women are living with their parents longer, so that would tend to suppress purchasing for their own household. You can see that there. They are also delaying families, and the rate of increase is a bit higher for women than men. And again, families with kids, households with kids are the highest purchasers of our categories. But most importantly is their purchasing of other categories outside our industry, more smartphones. And women are more likely to adopt smartphones and allocate a higher percentage of their income to smartphones and similar types of personal technology. One of the key things to also make sure that we don't get caught up in that conventional wisdom of cautious consumers, because I think I've shown that it isn't a cautious consumers. They're just not spending at the levels in our categories that we might be used to. One of the other propositions that have been put forward, in fact, Denise Morrison, CEO of Campbell, just was at an industry conference recently, talked about a distrust of big food being a growing problem. And certainly with those consumables data, which is kind of highly representative of, quote, big food, that there does seem to be some validity to that, but we can explore that a little bit further in a few other charts later on. Really, though, let's take a broader context of our industry in the context of the overall economy. CPG isn't the only industry suffering. There's been a lot of press about teen retailers and other teen-oriented industries that are really having some difficult times. Abercrombie, Delia's are two very notable ones, American Apparel. And where's all that money going? Well, it's going to, as I mentioned, smartphones and technology. So by definition, income is basically fixed at a given point in time. These 10 million smartphones that were sold in a weekend, that expenditure has to come from somewhere, and it is coming disproportionately from apparel and from consumer packaged goods. And in economic terms, we call that the substitution effect. So given a lack of price change in a basket of goods, apparel and CPG, we would expect those sales to continue to be sluggish. And that's going to be key in tying in with when we talk about trade promotion. And it's really not even the fact that sales overall are sluggish. I mean, if we note that the economy is quite strong in the areas where there's a vibrant tech sector, particularly on the West Coast in Texas. And oh, by the way, that's where Costco has the highest concentration of their stores. And Costco has the best performance of any mass market retailer out there in terms of same-store sales growth. So they certainly aren't a retailer that's showing the similar sluggish trends as most of the other retailers in our industry, say the Albertsons and Safeways and Aholds of the world.
Yeah, Kurt, we had a question come in regarding a previous slide. What about the substitution effect from millennial men? Talked about millennial women before.
Yeah, so what we're seeing, one of the things, and we're still looking into the definitively, because we did not see the same type of drop-off. And the hypothesis is one of the things was they weren't as big of quite as many expenditures on the smartphone type of technology, the high cell phone bills, all of that. That is probably the biggest area. Also, this is a demographic that has been living at home in disproportionate numbers for quite some time. It's a much more recent phenomenon with women. So those two factors I would expect would be the biggest explanation of that.
Okay.
So there's also one other macroeconomic factor to talk about, and that's the distribution of income growth. So even though the economy and consumer expenditures are growing, and you can Google this to just corroborate this, but most of the growth is coming at the highest quintile of income. So the highest 20% of households have disproportionate levels of growth. And so you can see here overall average expenditure, and the percent of those expenditures going toward that food and bev, the in-home food that the government calls it. And you can see, marginally speaking, for each incremental dollar of income, they are going to spend marginally less on our categories. So we don't get that full benefit of economic growth when there's a skewed distribution of income growth. If the income growth was more evenly distributed, we would probably see our sales tracking more at overall consumption rates, but that's clearly not happening. So that would tend to exacerbate some of those substitution effects that I've talked about. So that's what's going on in the external world, but we can't totally abrogate our responsibilities to fix what we can fix and what we can address. And one of the big things you would expect is if it truly is more of an industry or a macro factor versus industry factor, we should see those same sluggish sales occur across all types of companies, sectors, and company sizes. That, in fact, is not what we're seeing. If we look at Nielsen data over the last 5 years, and we're going to divide the companies by size of companies. So here's these tier 1 companies, these mega CPG vendors doing $5 billion plus. There's 20 of them. They're doing a third of the industry sales. They basically had no growth for the last 5 years, 0.6%. They don't really decline ever more than 2% in any given year, any individual company, but nor do they increase more than 2%. In fact, over the last 3 years, there's only been one of these 20 companies that have had at least 2% growth. Here's where the growth is coming in these tier 4 and tier 5 companies. So 50 to 250, and then even less than 50. So it's not where the industry tends to focus on private label growth, which is substantial, but it's not as much as these more nimble, dynamic, innovative, smaller niche types of companies. And those are companies, think of like Kind Snacks and nutrition bars, or OGX, which is kind of setting the world on fire in hair care, which has been a fairly stagnant category, or up until very recently Chobani and Greek yogurt. They're all companies that have been kind of entrepreneurial driven. There's one strong leader with a vision that's kind of driven that company forward. And so this skew right here suggests there are things within our control that we can address to fix performance in this industry. And I'm going to focus really just on a couple of them.
Before that occurred, a quick question that came in regarding Costco. Why is Costco winning versus other retailers who are also based in the West Coast? Is that correlation linked with their locations more so than any other factor?
Correlation is one. So if you look at the other retailer competing there, the location is Safeway, and they're clearly not winning. One of the things, and this kind of will tie into some of the discussion I'm going to have in a minute, as far as the way consumers get deals, want deals, and really need deals. So we talk about we want to appeal to the consumer and consumer-centric, but never is there a discussion that deals are a fundamental human need, particularly in the more developed economies, but I would suggest worldwide, and I'll show you the evidence of that. And so there is a major difference. Costco's EDLP, Safeway has played around with a bunch of goofy promotional strategies, and actually when they went to full-bore online, digital, and loyalty card, we saw a discernible decline in their sales directly linked to that. So that's one of the issues. The other is that Costco has a higher percentage of their sales in those consumer electronics, smartphones, TVs, etc. Safeway basically has none of it. So then if I look at, so one of the things people, well, there's all this migration to online and the natural food. I mean, certainly natural food is a little bit, I mean, that 4% is meaningful. It is growing. Online and consumables in the vast majority of CPG categories is really negligible at this point. We're even actually going to have this vitamin study where online is actually a big percentage of the sales, probably up 15 to 20%, and we actually saw a decline in online sales in vitamins, which is pretty meaningful, and actually kind of it stands as a bellwether. So if we're kind of rationalizing our sluggish sales due to migration to online, that's not occurring in the vast majority of categories, so we can't use that. And then natural foods really only has that impact among that 150,000 income plus, which as we've already noted, tends to have proportionally less impact in the industry overall. Here's more of the types of things that we're seeing when we go to trade. And you asked about kind of why isn't Costco seeing this, but some of these other retailers do. And this is something we see across many, many retailers is these types of, this is just one example, but I call it the desert of despair, where they changed over promotional execution and it had dramatic effects on their sales. This is for a shaving product, so you see at this retailer huge increases, incremental sales, no impact to baseline, still staying very stable. Change in promotional strategy to what I'm calling kitchen sink ads. Hey, let's just throw everything in and give them less of deals. So these are the discounts down here. And you can see how much that hurt their incremental sales, down 77%. Hurt their sales 26%. You say, well, that's just one instance. I mean, we're kind of making these macro conclusions based on one instance. It's not one instance. It's hundreds, if not thousands of instances that aggregate up to a discernible, meaningful impact on the industry overall. There's been quite a few retailers that have made pretty dramatic changes in their promotional strategies, and these are the effects that we continually see. In fact, that was the catalyst for me doing this particular webinar and related webinars that you can see on our website, is this kind of self-defeating promotional strategy that we consistently see with particularly larger Tier 1, Tier 2 manufacturers. Here's another microcosm. This was presented by one of our clients, R&B, at the recent Promotion Optimization Institute, and it really kind of is a microcosm of one brand, Ragu, that as they acquired these from Unilever, a Tier 1 company, they were looking at a business. Retail sales was down. It was down. Their base business was pretty much flat, not down. It was really their incremental business, way down 16%. And we identified that it was a quantity and a quality issue. So they were promoting less, and they were the lifts per event were lower. And that is, as I said, an industry microcosm. We have seen that hundreds of times on large brands, that the shortfall in their businesses was laid squarely at incremental sales. There was one of the major cereal manufacturers, so they're saying, oh, there's this decline in demand for cereal. That is true. We do see some softening in their base business, but we saw dramatic declines in their incremental business. And so the majority of their issues lay in promotion. And this is a big Tier 1 publicly traded company that had some negative effects on their business due to promotion, and we see it time and time again, and I'm just showing this as a microcosm of what we've seen through the data we have access to. And so what's driving all that, and kind of the two misguided paradigms are kind of the big issues, is first of all, traditional trade promotion, bad. If I put a gun to the head of 100 people in this industry and said, are trade promotion spending, is it good or bad? You have to pick one. Most, I would estimate, would say it's bad. Okay, and how about loyalty marketing? Is that good or bad? Most would say, well, no, that's good. You get engagement and ongoing purchasing and all that thing. The reality based on our research is very much different. Traditional trade promotion, the things that you've done, your mothers did 20 years ago, 30 years ago, can be very good if done right. Loyalty card programs, by contrast, are mostly bad. They can be good. There's hope for them, but mostly they have been a drag on this industry, and that needs to kind of, even though the industry continues to march onward toward this misguided paradigm that they're good, somebody is going to break that mold and see that it doesn't have to be that way. And I'm going to show the evidence of that shortly. First of all, what's the consumer say about how they like to get deals? First of all, they employ all different types of strategies. They're just, on average, they're employing 5 different promotional ways to get deals. So we divide our deals into passive, meaning I just have to show up at the shelf and I get things like an EDLP or I get store brand private label. The active then are something where the consumer has to engage. So I have to look at a circular. I have to go from store to store to get deals. I cut out a coupon. Note how loyalty cards and its rank of tactics utilized rank so low. And we've done this with consumables and OTC. Consumables, it was in the middle. OTC, it was 9 out of 10. So the old school tactics are still much more preferred vehicle for consumers getting deals. I see all these aspiring futurists saying the death of the circular, et cetera, et cetera. Not at all the case. Maybe it's not as much as it was 5 years ago. Still the second most preferred method of getting deals in consumables. If we look then at what does this mean for selling, and this would take a bit longer explanation of this, but basically this was, and I built a whole long, not long, but much more strong case to show that there was a strong causation, not correlation, between high deal purchasing and more sales, meaning the more active deals that were offered and taken advantage of, the more consumers bought. Said another way, if you're not offering the deals, they're not buying. It's not as if all of a sudden they're going to migrate over their day in, day out business. And why is that? There's a lot of reasons that would take a whole nother webinar to explain, but basically there is a significant group of consumers where your everyday price isn't worth it to them. If they're not going to get it at a lower price, they don't get the value of buying that product. We call that, and it's this kind of crazy notion that we find in the world, it's called the law of demand. So the more the price is, the lower the demand. The lower the price, the higher the demand. You can't migrate people that don't get value out of at that higher price to all of a sudden pay a higher price. You're not training them. And so then there's this notion of, well, you're just loading up the consumer, or it takes from future weeks. And in academia, there's been this perpetual quest to find this elusive dip, and all these, academics just scratching their head on where is this thing? We can't see it in the data. And then they use all these exotic panel database models to prove, oh, no, it really does exist. Well, just that doesn't stand the test of intuition, that the standard of reality in our industry is retail sales data. So you can't use some other data source to prove that what we can see and prove and measure is wrong. That just doesn't work, because then you'd have to say that whole data source is wrong. And let me build this out a little bit. So if there was in fact pantry loading, it wouldn't explain 3 years worth of BOGO on ice cream we see at this southeastern retailer. And you can see 2 weeks on, 2 weeks off with BOGO, unabated for 3 years. The baseline, when it's not on promotion, stays at 10,000 units. You don't see it dip to nothing. You don't see consumers, even though there's this mind-numbing predictability to when these promotions will occur, it's not as if they're sitting it out these 2 weeks it's not on promotion. There's still 10,000 units being sold. One of these measure I'll talk about is incremental factor, meaning how percent of the total business is done above baseline. And here you could infer that if I eliminated promotions tomorrow, 80% of my business goes away. There's also this brand switching that, well, I'm just not, I get the lift, and maybe it doesn't take from future weeks, but it's true, I'm just taking from other brands. Well, here you can see adult incontinence, which if you think about what the product is used for, it's the ultimate non-expandable consumption, I guess, unless you're, a heavy beer drinker or something. But here you can see that there's 3 brands. One's a private label promoting regularly. It doesn't matter when one's promoted before or after the other. The lifts are the same throughout. The baseline is actually increasing on this black one over time as they're promoting with a fairly high level of promotional cadence. So again, we see these things time and time again. Where is this dip? Where is this switching? We don't see it. You say, well, there's only so much you can promote. I mean, what, you're going to do it forever? Or are you going to, well, again, look outside of your narrow category, even total U.S. world. In Canada, the level of promotional cadence and frequency and depth is 3 times more than what we see in this U.S. Here's 2 representative categories. So our incremental factor in one category is 9%. Canada, exact same brand profiles, category dynamics, incremental factor is 27. And another one, it's almost 4 times as high. So if in the U.S. in these categories, if we just doubled our incremental factor, that's 13% growth. So we don't even have to get to Canada. There is a whole lot more upside that we can be promoting. So I'm just not advocating helter-skelter, go spend like drunken sailors. Basically saying there's a way to generate incremental volume, and if we can understand how to structure the deals correctly, everybody can make money.
Okay, quick question that came in, Kurt.
Sure.
Are there any categories where you do see a loading effect due to trade promotion?
In consumer packaged goods, no. With higher ticket categories, and we'll see the math on why, the answer could be yes, which is cars, TVs, anything bigger ticket where there's a discernible substitution effect that has a meaningful impact on the household budget, that would. What we're talking about here are these categories that are just such a small percentage of even low-income household shoppers' budget that any given purchase doesn't have to impact overall purchasing. Even if Walmart went to EDLP, some type of hybrid strategy, they could generate a huge $25 billion in revenue. What's the proof? Look at their share, and this is OTC among people that aren't that active deal shoppers. They don't use many tactics, so 27%, doing a very good job. Among the people that like to shop for deals and go back and forth to different outlets, they're only getting 18%. Their share drops by 1/3. So if they all of a sudden employed more deals, and we've seen it on occasion, they'll do some pretty aggressive deals and they get normal types of lifts. They don't do it much. They could generate more revenue in the next 6 months than the total size of 7-Eleven or Dollar General. And we're talking a massive increase in sales potential if Walmart kind of went to a hybrid strategy. Is that realistic? No. But could they? Is that also a competitive advantage for other retailers that do decide to get more aggressive? How this all fits in is that I did my dissertation in 2008 called The Theory of Retailer Price Promotion. It's all incremental. Basically, the theory says that sales using retailer price promotion are entirely incremental at the brand, category, and promoting retailer and the market in general, and those effects are consistent with microeconomic theory. I've posted a full webinar that is on our website if you want to kind of understand the whole microeconomic theory and the empirical rationale on why this is the case. But certainly I should have shown you enough data now that should stimulate some, at least to question this dogmatic paradigm where you kind of buy into all this pantry loading, brand switching myth with no data or evidence to support it. At least open the mind to say there is a way to kind of get back some of the sales we lost to some of these other sectors. And one of the ways to do that, again, microeconomic theory, you have to lower the overall average price of the market basket. There is this thing I've developed called the arbitrage opportunity condition. I'm not going to go through the math here. Again, you can see that in the deck, but it basically is a formula to say if I can predict with some level of certainty the lift of a certain promotional strategy, I can then structure a promotion to where the retailer and my subsidy on the deals were both guaranteed to make money. So this condition can be met. And what can I use this formula for? Well, first of all, it explains why bigger ticket categories, and to that question earlier, are there categories where you see dips? In CPG, the answer is an emphatic no. Have not seen it. I've seen maybe out of probably 1 million distinct promotional observations I've looked at, do I see any evidence of brand switching? I've seen less than 10. Where there's a discernible kind of a negative impact on other products. But it could happen on higher big ticket products that have less margin in the value chain. But carb bev, you could keep promoting theoretically 52 weeks out of the year and see the same lifts. It's also a way theoretically for larger manufacturers to shake out smaller ones. The smaller ones don't have the base of business to even overcome the fixed cost of ad costs, and it's a manufacturer that drives the profit condition. But larger manufacturers, that are on this eternal quest to get the niche players off the shelf, this would probably be the easiest way to do it, yet they don't really do it to the degree that they could. So that's why then the innovation and all the other things that smaller brands bring to market are what's driving the growth. And it is the manufacturer driving the go, no-go decision because they're paying, and you see that right here, they're the ones paying the ad cost. And so again, you can get more information on this from the webinar that I talked about that's on our website. Now, what's predominated now over the traditional option is loyalty cards, and they're bad for everyone. Consumers, manufacturers, retailers, they're not a complete lost cause. Some can work, but they have to be done in the context of what's kind of right for the business. I would say there's 6, and again, this is more there's a whole webinar on the false hope of loyalty cards on where I talk about this in more detail, but one of the ones that I see is the biggest impediment to loyalty cards working is its exclusionary nature. So they're basically a nice way of telling marginal customers that they're not wanted. So I've already shown evidence that active deal consumers like to shop for deals. They bounce around to different outlets. Yet if I go to the register, you're not giving me the deal. That's a consumer that I've just alienated. They're also not as compelling. So the way the deals are structured now, it's harder to get to the price points that we used to be able to get to really drive the incremental sales. Here's that evidence where we talked about the average number of outlets shopped, and in fact, the loyalty customer is among the least loyal consumers in your store. Besides rebate users, they shop at more outlets on average than any of the other users of these tactics. And you can see overall that active deal shoppers shop at more outlets. They bounce around to a bunch of different stores than the passive deal shoppers. So, and that's why I have it in quotes. They aren't loyal, they're just heavy. They like to buy stuff. And why do they like to buy stuff? Because they like deals, and loyalty cards are one of many tactics that they use to get deals. Here's some examples. I mean, this is just a muddled mess of different worst practices on loyalty card. Here's the worst one. So I can buy this $10.99 with card, not clear what that discount is, and then I get an extra, 5%. Hold me back, and then I have to buy 6 to even get a stinking 5%, not even a 5% discount. So I have to throw out $60, more than $60 to get a 5% discount. That's how I'm going to employ my loyalty funds? Those you just go through any given circular. Pick one at random and look at the ways, the contortionary offers that retailers and manufacturers are having consumers to jump through to get these rewards and just making it simple and easy for them to understand. And they aren't understanding, or a good part of them aren't understanding, incremental sales fall a lot. And they're expensive now because the vendor's usually the one covering the subsidies on these deals. And they're bad for retailers. As I mentioned, when incremental sales fall, they fall for retailers and manufacturers, and they're not very profitable. So you say, well, hold on. You see, Kroger's so profitable. They're doing great. Well, we'll take a look in a second at the evidence on here, but here's that desert of despair. Unambiguously, we can see where the loyalty card program started at this retailer. Nice big lifts here, loyalty low lifts here. Here's the impact on incremental. Here's the impact overall. That's over a 52-week basis. You actually see the baseline increased. And see, you migrated, you got them off. No, it was just a new planogram because you see all of a sudden the sudden shift and the baseline gets higher. It certainly didn't, not a massive increase to offset all that lost incremental volume. Here's another one where you have, this desert of despair for, a ton of weeks. Has a discernible effect on business once I got in and out of those traditional trade promotion, display, TPR type of activity. Here's that empirical evidence I talked about. So Kroger, here's the big three, and typically in the industry that we think of the real heavy users of loyalty cards. This was done before the Safeway-Albertsons merger and before the Tesco debacle that you perhaps have written about. So Kroger's held out as best-in-class loyalty. $100 million in sales, $2 million in profit. Publix is more profitable than Kroger, with less than a third of the sales. And one of the big promises of loyalty cards, you focus on your most profitable consumers. So gross margin should be going up over time. Not happening at any one of these retailers. So we just don't see any of the positive effects. So does that say Kroger's doing a bad job? No, they do a great job in many other areas. It's just that it would be very difficult to say that loyalty card is the primary driver of their recent success, profit-wise, and their same-store success has been sustained over quite a long time. And it's certainly loyalty cards didn't prevent failure from a lot of these very high-profile closings at Fresh and Easy. Dominic's, Tesco's had, they were the pioneers of loyalty cards. I mean, they certainly weren't able to stave off any real competitive threats from EDLP food retailers. So what about all these great insights you can get? You ignore the dealing, but go back to the empirical results. If the insights were that great, we would be able to drive meaningful macro results, and we can't get that. Another shortcoming is you don't get full market visibility, so all you're reading is what you're, the results of what you're doing, not what could be done. There's also some others. So, also we get down to just basically what can you do with this data? Well, you send a coupon, and then there's more efficient, more effective ways to do that than muddling through a ton of data for sorry, I'm looking at a note somebody's saying here. So there's much more efficient ways to deliver a deal than all this loyalty card data. There's also a lot of other self-limiting behaviors I won't get into in much detail, but it really has to do with kind of how the big retailers and the big manufacturers are doing their jobs. And, we don't empower people as much, so people really don't have the ability to, go outside their budget, and they need 20 approvals. Well, these small manufacturers that we saw the decent growth, they're nimble, they move, they make decisions, they get consensus on a small group, and they go. Rigid retailer requirements are limiting a lot of the ability to, get more creative from a promotional standpoint, and we're just dealing with all these budgets and bureaucracies. So let's take a checklist then of what have we learned. So what's wrong with CPG? Is it cautious consumer? No. They are spending, but they're not spending on our categories as much. The whole distribution, so the fact that most of the income growth is coming to the highest 20%, substitution effect is the biggest factor. And then millennial effects outside substitution that are hitting women on living at home longer, delaying having kids. The company scale on industry factors, so big companies lagging smaller ones. Trade promotion, showing you how that has had a negative effect. E-commerce is not a factor overall on a macro basis. Alternative channels, combined with this whole health and wellness thing, slight effect, and then the whole self-limiting corporate behavior. So what can be done? First of all, we accept loyalty cards for what they are, methods for deals. They're not a way to get engagement or any of those other types of aspirational ideals. Eliminate the contortionary offers. Just give them an easy deal that they can take advantage of when they're in your store. Restructure the subsidy model so the manufacturer doesn't have to pay the brunt of it because they can't afford then to promote as deeply and as regularly. Use these to enhance and not replace the core deals to consumers. And that's what, on a macro basis, we've seen many manufacturers do. There are a lot of great retailer-only applications that manufacturers don't even have visibility to and shouldn't be investing resources in on. Store location and aisle configuration, all those types of things. Essentially, from a retailer perspective, it's a way to get deals. So also then we say trade promotions should be good. You can make money. When you're looking at trade promotion optimization options, you're not looking at software. You should be looking at it from what can I do to expand knowledge. Software is the vehicle to facilitate that knowledge. It's not the end in of itself. Too many times we see these big IT departments running this process when it should be a kind of a joint effort between trade marketing, field sales, marketing, and IT. The old school vehicles are still most preferred, more than loyalty cards, more than online digital. It's still a mass market. We still have to generate masses of volume, not all this niche-y digital stuff. So understanding women 35 to 54 with kids are still our biggest target. Understanding that seniors have the most discretionary income. Millennials are not where it's at for our industry. Maybe in the future, that don't ignore them entirely, but understand the volume is not with millennials. It's with the other older targets. And then finally, pursue riskless profits. There is a way to make money, take no risk, and at minimum, it's worthy of a test. Certainly all the other things that have been tried and tested and run are not working, and that's very clear from the data. So with that, I thank everyone for attending and listening, and now I can open it up to questions.
Okay, there are a few that came in, Kurt, that I didn't want to interrupt you because you were really rolling with a very compelling presentation. It was really compelling. One, given your view of loyalty cards, what explains the valuation and acquiring interest in dunnhumby, for example?
Well, I think it's first of all that flawed paradigm that they believe it's this fountain of great insight, but which is very odd given that dunnhumby was attached to the hip of Tesco and they had all those disasters. Nevertheless, I didn't see a valuation though attached to the assets that Kroger bought, and I interpret that to mean it was not a high enough valuation to be material because public companies have to disclose that type of thing, I thought. I'm not positive on that. Somebody can correct me if I'm wrong, but I mean, that would explain it as just the misguided paradigm that there's, this fountain of insight and profits, which just hasn't transpired.
Okay. Another question, with all the quantitative data supporting effective trade promotion, why is it not more widely embraced?
Again, you get to the paradigm, and I don't know. It is just, I think we are baked into an industry that is, goes back to the 30s when Nielsen, a share mentality. It's fixed pie. We can't grow. And so those paradigms carry through. Lowering the price seems to be kind of not what we all went to grad school for. If I'm a marketer, I want to have my toys and have my big advertising budgets. But yet there's just not the data to support it. It's almost this religious faith that trade is bad versus just looking at some very basic data. And then when they do look at the data, they're looking at share changes. Well, by definition, if I'm seeing a big lift in the sales of one item, share goes down on all the other items. That doesn't mean their sales go down, but share is fixed at 100. Look at sales by sales, not share, and you'll see that those insights then should come along. But I'm not under any delusions that you'll kind of come over right away because I've taken people through this for hours and they still will hold on to their beliefs. But a couple of you, the more open-minded of you, can start looking for yourself.
Okay, final question, and this refers to much earlier in your presentation that I didn't find a place to jump in. Your findings are objective and clearly show trade promotion does not hurt categories. Is it the same for all other CPG categories? Are there any that do show baseline drop-offs due to loading?
No, I think we did ask that. No, there's none. There are some that don't show much of a lift, and it's not worth promoting. That's a different topic. But when they do promote, it's not cannibalizing, shifting, any of that negatively perceived dynamics. It is all incremental.
Okay, well, great, Kurt. Thank you very much. That was very compelling, like I said, and we appreciate it.